On September 15, 2022, Ethereum completed one of the most consequential technical transitions in the history of financial infrastructure. The merge, converting Ethereum from proof of work to proof of stake, eliminated 99.95% of the network's energy consumption overnight and introduced a native yield mechanism for participants willing to lock 32 ETH as validator collateral. For institutional investors, this transition fundamentally altered the investment thesis for Ethereum. ETH is no longer simply a digital commodity powering a transaction network. It is now an asset that generates yield through network participation, with a monetary policy that can result in net deflationary supply dynamics when network activity is elevated. The mechanics matter enormously for institutions. Understanding validator economics, slashing risks, withdrawal queues, and the liquid staking ecosystem is not optional for any fiduciary considering an ETH allocation. This analysis provides the framework investment committees need to evaluate Ethereum's proof-of-stake system with institutional rigor. The proof-of-stake validator lifecycle is straightforward in principle but operationally complex for institutions at scale. A validator node requires exactly 32 ETH, approximately 0.000 to 20,000 at recent prices, and must maintain near-continuous uptime to maximize rewards and avoid inactivity penalties. For institutions seeking exposure to staking yield without the operational complexity of running validator nodes, liquid staking protocols have become the dominant solution. Lido, Rocket Pool, and Coinbase's cbETH product collectively control a majority of staked ETH, issuing liquid receipt tokens that can be deployed in DeFi or held as yield-bearing ETH equivalents. The institutional trade-off is clear: operational simplicity at the cost of smart contract risk and centralization concerns. The slashing mechanism is critical for risk officers to understand. Unlike the voluntary risk of underperformance in traditional asset management, slashing is a permanent, punitive capital loss triggered by specific validator misbehaviors. Institutional validators, typically operated by firms like Figment, Blockdaemon, or Attestant, have track records of zero slashing events, but this risk must be explicitly modeled and disclosed in any institutional investment mandate. Ethereum's advocates describe ETH as a triple-point asset, simultaneously functioning as a commodity that powers computation, a yield-bearing instrument via staking, and a potential store of value with deflationary monetary mechanics under high-demand conditions. This framing is analytically interesting but requires scrutiny from investment committees. The deflationary mechanic is real but conditional. EIP 1559, implemented in 2021, redirects a portion of every transaction's fee to a burn address rather than to validators. When the Ethereum network is congested, as during NFT frenzies or DeFi summer activity, the burn rate can exceed the issuance rate, reducing total ETH supply. During quiet periods, ETH is mildly inflationary. This makes ETH's monetary policy adaptive rather than fixed, which is either a feature or a bug depending on your investment philosophy. The staking yield, currently around 3.5% annualized, is attractive relative to cash in certain rate environments. But institutions must account for ETH price risk, smart contract risk in liquid staking protocols, and the regulatory uncertainty around whether staking rewards constitute taxable income at the time of receipt, a question the IRS has not definitively resolved. Lido's dominance in the liquid staking market is both a testament to its product-market fit and a genuine systemic risk that Ethereum's developer community actively debates. With approximately 30% of all staked ETH flowing through Lido smart contracts, a single protocol failure, governance attack, or regulatory action against Lido's operator set could have cascading consequences for Ethereum's consensus layer. For institutions, Coinbase's cbETH represents the most compliance-friendly option, a regulated custodian issuing a tokenized receipt for staked ETH, with clear tax reporting, institutional customer support, and a known counterparty. The trade-off is that cbETH's yield is slightly lower than native staking due to Coinbase's fee structure, and the centralization concerns are arguably greater with a single, regulated US entity controlling a large validator share. Rocket Pool's decentralized model, requiring only 8 ETH per mini-pool with node operator collateral, offers better decentralization properties but introduces additional smart contract complexity. For institutions prioritizing decentralization risk management, Rocket Pool's architecture may be more appealing despite its smaller market share. The SEC's February 2023 enforcement action against Kraken, resulting in a $0 million settlement and shutdown of Kraken's US staking service, sent a clear signal that staking as a service is on the regulatory radar. While the regulatory landscape has evolved since then, Institutions operating under SEC oversight must carefully structure their staking activities to avoid characterization as an unregistered securities offering. The operational risk of slashing is manageable with proper infrastructure but must be explicitly disclosed in investment mandates. Professional validator operators with 5 or more years of clean track records exist, and their historical slashing rates are effectively zero. But zero history does not mean zero probability, and risk officers must model catastrophic scenarios accordingly. Smart contract risk in liquid staking is perhaps the most difficult to quantify. Lido's contracts have been audited by multiple top-tier firms and have processed hundreds of billions in transactions without critical failure. But the DeFi graveyard is filled with protocols that passed multiple audits before falling to novel exploit vectors. The correct institutional response is not to avoid liquid staking entirely, but to size the exposure with smart contract tail risk explicitly embedded in the position limits. The merge's impact on Ethereum supply dynamics was dramatic and immediate. Under proof of work, Ethereum issued approximately 5.4 million new ETH per year to compensate miners, a roughly 4% annual inflation rate that represented a continuous dilution of existing holders. This made ETH structurally different from Bitcoin, which has an absolute supply cap. Post-merge, ETH issuance dropped to approximately 700,000 ETH per year to compensate validators. Crucially, the EIP 1559 fee burn mechanism, which existed before the merge but became more impactful alongside it, burns ETH in proportion to network usage. During periods of elevated demand, the burn rate has exceeded the issuance rate, resulting in net deflationary periods where ETH supply actually contracted. This creates a novel investment dynamic. ETH's monetary policy is endogenous to its own network adoption. The more the Ethereum network is used, the more ETH is burned, the tighter the supply becomes. This feedback loop is theoretically powerful, but it also means ETH's monetary policy is less predictable than Bitcoin's, a consideration that institutional investors with fixed income-like requirements must weigh carefully. Ethereum's transition to proof of stake is a genuine paradigm shift, not just a technical upgrade, but a transformation of the asset's economic profile. Institutions that evaluated ETH in 2021 under proof of work are looking at a fundamentally different instrument today, one that generates yield, has a more nuanced monetary policy, and requires a distinct operational framework to access safely. The investment committee conclusion for most institutional allocators is that ETH belongs in a different risk bucket than Bitcoin. Bitcoin's investment thesis is relatively simple: fixed supply, no yield, digital gold analog. Ethereum's thesis is more complex: productive capital, variable monetary policy, yield-bearing but with smart contract risk, and a regulatory environment that requires active legal monitoring. For institutions with the operational capability and regulatory clarity to participate in staking, the yield component makes ETH an attractive addition to a digital asset allocation, particularly as a diversifier against pure BTC exposure. For institutions with simpler mandates, the spot ETF route provides clean economic exposure without the operational and regulatory complexity of the staking layer.